Your breakout looked clean until price paused, flicked above the highs, tagged your stop, and ran without you. You waited for the pullback, stepped in, and the very next candle reversed. It feels personal, like the market watches your entries. It is not. What you are seeing is inventory management by larger participants who must source liquidity before they move size. Today, we slow the picture down and read what their activity leaves behind in volume and structure, so you can stop reacting to every tick and start protecting your attention and capital. We will keep it simple, practical, and calm. We will look for footprints, not stories, and we will act only when evidence lines up. Mind Over Markets offers clarity under pressure. If you have ever said, "The move started the second I got out," this lesson is for you. This lesson gives you a simple lens for the next chart you open. We will not try to divine the future. We will study how larger participants search for liquidity, how they stage entries and exits, and how those actions shape structure and volume. If you are a serious retail trader who has been whipsawed by clean breakouts that turn dirty, this is designed for you. The promise is modest and powerful. You will leave with a way to frame the market that protects attention and capital, helps you filter noise, and guides you toward fewer but better decisions. The single big idea is context over prediction. Price is not chaos. It is the visible result of inventory and risk management by players who must move size. We read their footprints, wait for agreement between structure and flow, and then act with clear invalidation. No drama, no rush, just a repeatable practice you can refine day by day. 3 years ago, Alex kept a neat journal of red days. The entries all sounded the same. Chased a breakout, stopped out, re-entered, gave back gains. He blamed indicators, then brokers, then luck. On a quiet Sunday, he printed 20 trades and wrote one question at the top of each page. What would a large player need in order to fill size here? He did not change the chart, he changed the question. The next month, he slowed his routine. He marked areas where price had moved quickly and then stalled, and he layered volume profile to see what the market had accepted and what it had rejected. He noticed that his entries were often inside obvious liquidity pools. He began to wait for evidence of absorption and a small shift in structure before he touched the keyboard. Sometimes that meant doing nothing for hours. It was uncomfortable, then liberating. He set 3 rules in plain language. If I cannot explain the counterparty, I pass. If the stop sits inside an obvious pool, I pass. If structure and flow disagree, I pass. He still took losses, but they were planned and bounded. His win rate did not jump. His average loss shrank, and his attention stopped fraying. 6 months later, the journal sounded different. Fewer trades, clear reasons, patience that felt earned. The market had not changed. His process had. The market is an inventory system. Large participants carry risk, source liquidity, and manage positions across time. Their goal is to transact size with minimal footprint. Price is the public record of this private problem. When liquidity is scarce, price moves to find it. When liquidity is abundant, price can pause and accept. You do not need to predict where price will be. You need to read what participants are trying to do right now, and whether the tape confirms it. We infer intent from footprints. In ranges, repeated rejection with steady volume can signal accumulation or distribution. On the tape, passive orders absorb aggressive hits, then imbalance shifts. In structure, a lower high fails to break, or a higher low refuses to give way. Volume profile shows acceptance as high volume nodes and rejection as low volume corridors. Liquidity pools cluster above clear highs and below clear lows. The map is simple. If structure and flow align, plan a trade. If they diverge, stand down. Every plan has an invalidation line. If the next wave of trades flows through your line, accept it and exit. Your job is to protect attention, Take measured risk and let the market pay you when a crowd offers liquidity in the wrong place. First, accumulation is the quiet build of a position by larger participants inside a range before a drive. They prefer to buy when sellers are eager and price acceptance is clear. You will often see price rotate within a box while volume builds around a few price levels that the market accepts. High volume nodes mark acceptance, low volume lanes mark rejection and paths of least resistance. If price tests a low, aggressive selling hits, and yet the low holds as passive buyers absorb and the next rotation prints a higher low, that is a clue. If that pattern repeats and structure stops making lower lows, plan to risk a small unit below the most recent failed pushdown. If the next auction slices through that low with expanding volume and no absorption, your idea is wrong. The common trap is buying the first pop before acceptance. Second, the absorption principle describes how passive orders from larger players quietly take the other side of urgent trades without chasing price. On the tape, this shows as a stream of aggressive market sells that fail to push price lower, or market buys that fail to push higher. In footprint views, this can appear as heavy volume at a level with little progress. In structure, you may see repeated tests of the same price that stall and reverse. If you spot repeated aggressive pressure into a level, see delta negative or positive without distance, and the rotations start to turn, prepare a plan. If then the next test shows less progress and structure shifts, enter with risk tucked behind the absorbing level. If the next sequence lifts cleanly through the level that was absorbing or dumps through it, your thesis is invalid. The trap is fading without evidence. Third, liquidity refers to where stops, resting orders, and interest concentrate. Pools often sit above obvious swing highs and below obvious swing lows. A grab is when price reaches into a pool, fills those orders, and then snaps back as the fuel exhausts. Clusters are zones where many participants want in or out, often near round numbers or prior value areas. If you map recent extremes and see a shelf of equal highs, assume stops live there. If a push tags the shelf and immediately stalls with absorption on the tape and a small structure shift, that can be the handoff from weak hands to stronger hands. Plan entries only after the handoff, with risk beyond the pool. If price slices and accepts beyond the pool, abandon the idea. The common trap is placing stops where everyone can see them, and then chasing the grab. Fourth, distribution is the mirror of accumulation. Larger participants use strength to sell inventory to eager buyers without tipping the market. You will often see price mark time near the top of a range while volume builds and progress slow. Sharp pushes up that fail to find follow-through and then revert are common. If you notice repeated higher wicks into the same zone, heavy volume at the offer, and a slight lower high forming, watch for the handoff. If then a lower low prints after the last failed push and bounces back weakly, consider a short, with risk just above the distributing shelf. If price lifts and accepts above that shelf, your idea is invalid. The trap is shorting the first red candle in strength without evidence of acceptance turning to rejection and without a clear plan for risk. Fifth, volume profile and market structure give you a map of acceptance and the path of least resistance. High volume nodes are areas where the market did a lot of business and tends to pause. Low volume corridors are areas the market moved through quickly and can traverse again. Structure is the sequence of highs and lows that define control. If price moves from a high volume shelf into a low volume lane and then stalls at the next shelf, ask who is in control. If then order flow supports the push away from the shelf, you can frame a trade with risk tucked behind the shelf. If price accept back into the prior value and structure flips against you, exit. The trap is trading every wiggle without regard to acceptance and ignoring the context provided by the profile. Sixth, liquidity clusters are zones where many orders congregate due to memory, round numbers, or prior value edges. These clusters can act like magnets during auctions and then as springs once filled. You can often see them where equal highs align, where previous session highs and lows sit, or around clear profile edges. If a move approaches a known cluster with rising urgency, be cautious of late entries. If then the test into the cluster shows exhaustion on the tape and a small structure shift away, plan a trade with risk beyond the cluster. If the auction accepts beyond the cluster and builds value there, step aside. The trap is assuming a cluster must reverse price every time and fighting acceptance with repeated fades instead of waiting for evidence of failure before acting. Seventh, order flow is the record of who is hitting and who is absorbing in the moment, and it helps you infer intent. When aggressive buyers lift offers and gain distance, intent is to push higher. When aggressive sellers hit bids and go nowhere, someone may be absorbing. Watch for sequences where delta runs but price stalls, or where small bursts produce outsized distance. If you see a run of buys into a level that stops moving forward and then rotation turns down, plan a short with risk above the stall. If you see sells absorbed at a low, then a higher low print with a shift in flow, plan a long with risk below the failed low. If intent flips against your position, exit without debate. The trap is reading one print in isolation without context. Eighth, markets often rotate through phases that reflect institutional objectives. Accumulate inventory, mark up, distribute inventory, mark down. These are not neat boxes, but they leave patterns in acceptance and structure. During accumulation, value builds and progress is slow. During markup, price moves through low-volume lanes and pauses at shelves. During distribution, value builds near highs and rallies fade. During markdown, bounces fail and lows step down. If you can place the current action within a phase, you can set expectations. If then you see behavior that does not match the assumed phase, reduce risk or stand down. If the environment changes, you change with it. The trap is forcing a phase label on every chart and ignoring evidence that the dominant behavior has already shifted. Ninth, risk management is the part of your plan that keeps you in the game long enough for skill to matter. Define your unit of risk per trade so that a string of losses is survivable. Place stops beyond the area that would prove the idea wrong, not inside obvious pools. Size positions so that a loss is an inconvenience, not a rupture. If you do not see a clean invalidation level, pass. If then the trade triggers and moves in your favor, consider scaling decisions in advance rather than on impulse. If the market immediately trades through your line, take the exit without negotiation. The trap is centering everything on entries and ignoring the math of loss, which is the real driver of account survival and emotional stability. 10th, patience is a position. Your time and attention are finite and must be spent on high-quality opportunities. Position timing means waiting for structure and flow to agree and then acting without hesitation. It also means staying light when conditions are noisy. If you map your day into planned windows and set alerts at key levels, you remove the need to stare and chase. If then your level trades and the footprints match your plan, you execute the next small step. If the level trades but the evidence disagrees, you do nothing and keep your mind clear. The trap is burning attention on constant monitoring and then entering from fatigue rather than signal, which leads to poor timing and a sense that the market is against you. 11th, the moment of confluence is when multiple lines of evidence agree enough to justify risk. Structure aligns with order flow. Liquidity context supports the idea. Volume profile shows acceptance handing off to rejection or the reverse. You do not need perfection. You need enough alignment to act with a small defined risk. If you see a level test with absorption, a shift in highs and lows, and a low volume lane opening in your direction, you have confluence. If then price confirms with a clean break and a retest that holds, you can add or simply hold. If the break fails and acceptance returns to the prior area, exit and reset. The trap is adding indicators to chase certainty instead of defining a few strong signals and training yourself to wait for them. 12th, passive versus aggressive flow and the existence of dark venues add nuance to your read. Aggressive orders cross the spread and move the tape. Passive orders rest and absorb. In many venues, a portion of volume trades away from the lit quotes, which can explain moments where lit order flow seems thin, yet price holds. You are not trying to decode every venue. You are trying to ask whether urgency is getting paid with distance or smothered by resting interest. If you see urgency fail at a level and rotations start to turn, act with risk behind the level. If urgency wins and distance expands, stand down or join on pullbacks with tight risk. The trap is using unseen venues as an excuse to ignore the evidence that is actually visible. Think of the market as air traffic control. It sequences planes, not just watches the sky. Orders queue, merge, and peel off so that the runway stays safe. That is order flow. A river picture helps. Fast water moves through narrow channels. Eddies form behind rocks where pressure collects. Those eddies are liquidity pockets where price pauses and turns. A warehouse image is useful. Shelves packed with boxes are high acceptance. Empty aisles are low acceptance. Moves travel quickly through empty aisles and stall at full shelves. A lighthouse image adds caution. The light does not move ships. It warns of shallow shoals. Clear equal highs and round numbers can be shoals that attract but also wreck the rushed. Price is an X-ray that shows bones. Footprint and volume are an MRI that shows soft tissue and flow. Here is what we know and what we assume. Several central bank and regulatory studies, including work by the Bank for International Settlements, the European Central Bank, and the Financial Conduct Authority, describe how liquidity conditions shape price impact and how a large share of turnover comes from institutions that must execute size with care. Academic research on market microstructure shows that price changes are closely tied to order imbalance and available depth rather than news alone. That supports our focus on footprint and context. When we say accumulation, absorption, or liquidity grab, we are describing patterns that we can observe on the tape and in volume, not a guarantee of direction. What is assumption here is the why behind individual prints. We infer intent only when structure and flow agree, and we always tie conclusions back to risk and invalidation. Set up your chart on a clean template. Choose a liquid instrument and a time frame that matches your attention span. Add a volume profile tool that lets you draw a fixed range. Pull the range around the current auction from the most recent swing high to the most recent swing low. The tall shelves you see are high volume nodes which mark acceptance. The thin corridors are low volume lanes which mark rejection and potential paths of least resistance. Mark the edges of the main shelf. These edges often act as decision points. Now add a footprint or tape-style view. You want to see whether aggressive trades are gaining distance or getting absorbed. Look for sequences where market buys lift the offer without progress, or market sells hit the bid without new lows. That is passive interest stepping in. Note the level where this keeps happening. That is your absorbing shelf. Next, map obvious liquidity. Draw lines over equal highs and under equal lows. Note round numbers that have been tested several times. Add the previous day high and low and the session open. These are common clusters of resting orders and stops. Build a simple plan. If price trades up into a known pool and you see buys that fail to gain distance and structure prints a lower high, then consider a short. Place your stop a small distance beyond the pool so that a clean acceptance will knock you out. Risk one unit only. First target is the nearest low-volume lane. If price breaks the shelf and holds below it, you can scale a partial add with the same unit size. If the level accepts above your stop, exit and stand down. If price instead trades down into a pool and sells fail with a higher low, reverse the logic for a long. The goal is to act only when structure, flow, and liquidity context agree, and to get out cleanly when they do not. FOMO is the urge to act before the picture is clear. It grows when you watch every tick and confuse speed with signal. You cool it by defining what good looks like and agreeing to do nothing until those conditions appear. Boredom during quiet accumulation is another test. It tempts you to invent trades just to feel engaged. Treat boredom as a sign that the other side is paying you to wait. Liquidity grabs can rattle confidence when your stop prints and the market runs without you. The way through is not to move stops out of fear. The way through is to make the same calm decision every time. If the market accepts beyond your line, you are out. If it rejects and returns with clear evidence, you are allowed back in. Here are 3 drills that compound. First is the delayed entry rule. When you feel the urge to chase, require 1 extra check, either a second test of the level or 1 full candle close that confirms the shift, or a fixed number of breaths while you reread your plan. If the setup survives that pause, take it. Second is the pre-trade checklist. Ask 3 questions out loud. What is the structure? Where is the liquidity? What footprint confirms? If you cannot answer in 1 or 2 plain sentences, you pass. Third is the post-trade debrief. Write a short note within 5 minutes. Did I follow my entry rule? Was my risk in the right place? What did the other side need and did they get it? Keep the notes short and honest. Review 10 at a time each weekend to spot patterns you can fix. Join the conversation below. Comment composure if you are choosing patience over prediction this week. Type confluence when your plan has 3 signals that agree. If the market stopped you out and then moved without you, write trap and say what level you missed. Share a chart screenshot of your last confusing move and a 1-sentence read of structure, liquidity, and flow. We will pick a few for a chart clinic in the next episode. Quick poll for you today. Where do you break your rules most often? Entry timing, position size, moving stops, or taking profits too soon? Vote and tell us why. If you want a deeper dive on a tool or a case study, name the instrument and time frame, and we will build around the most requested ideas. This content is education only and not financial advice. I do not know your situation, and I will never tell you what to buy or sell. Markets involve risk and losses can exceed your expectations. Use position sizes that keep you in the game, place stops where your idea is proven wrong, and journal each decision. If you are unsure, do less, or seek independent professional guidance. Your first job is to protect capital and attention, not to chase returns. Let us end with one clear idea. Context over prediction. You are not trying to be right first. You are trying to be useful and safe. Read structure. Map liquidity. Confirm with flow. When these agree, take a small risk with a clean exit. When they do not, step aside and keep your attention intact. If this helps you think more clearly, share it with a friend who trades. Subscribe for a steady practice of mechanics and psychology. In the next episode, we will break down a live market sequence from range to drive and show how volume profile and tape confirm the handoff. If you want that lesson on your chart, post the instrument and time frame below, and we will build it.